My name is Michael Duke. Welcome to my show where I talk about investment opportunities on the public markets that I think are interesting. So if you think that's interesting, then please be sure to consider liking this video and subscribing to my channel. Um, as always, the opinions presented here are not financial advice and they are not a recommendation to buy or sell a particular security. Without further ado, let's get into it. Today, I'm going to be talking about MPLX LP, ticker MPLX. This is not a stock, okay? It is a master limited partnership. Despite the fact that I have a very large percentage of my net worth tied up in master limited partnerships, I have neglected to cover them on this channel, mainly due to laziness. But I can wait no longer because I have so much material that I can cover with them. I've decided to start with this. I do have a position in this uh, security. It's not a stock. It's a common units of an LP. We'll talk about that in a moment. We'll talk about what's the difference between a stock and an MLP. I do have a position in this. It's one of the top three positions in my portfolio, and um, it's done very well the last few years. And it's done particularly well since oil, the price of oil was negative in the depths of the COVID crash. Um, all of these MLPs, they went down by 80-90%. In fact, I think we can visualize that. You see here, it was $32. It went to 13. So yeah, 60-70% drawdown, went down to below 12, has since recovered to 53. So yeah, that's almost a 500% return, or over a 500%, almost a 5x return on the units. So let's talk about it. What is an MLP? Well, if you've ever invested in a real estate syndication, you might be familiar with the idea. But basically, when you buy a stock, you're buying an equity investment, and typically with a stock, sometimes it's not the case, but typically stocks have voting rights. They have decision making rights. Um, MLPs are different. Typically, they do not carry decision making rights. In fact, in a master limited partnership, you have what's called a general partner. And the limited partners are all of the unit holders, of which you are one if you purchase the units, one unit being $53.10. So the general partner is the entity that essentially controls the partnership. Okay. And they hold a large percentage of the LP units as well. Why is it set up this way? Well, corporations are, what you're buying an interest in with a stock, pay income taxes prior to distributing dividends and calculating their earnings per share. Master limited partnerships do not pay income taxes at the corporate level, and they pass through the tax burden to the unit holders. So what that actually means is if you buy MLP units of any type, then you will receive a form called a K1 from the company that you have to file with your taxes. So why would anybody do this? Why would anybody invest in a vehicle that exposes you to tax implications that you don't necessarily have to worry about when you're investing in stocks? The reason is tax deferred cash flow. The reason that a company, the sponsor, another word for the GP, the sponsor of the LP, the MLP, They will create a master limited partnership to put what I would refer to as kind of like a yield co or yielding type investments or assets into the master limited partnership to tax advantage them because there's a lot of capital investment and depreciation. In other words, the assets that are owned by these MLPs, there's a lot of book value there, and they throw off a lot of cash flow. So by putting them into this liquid entity that's traded on an exchange but has these tax advantages, the sponsor can monetize their assets in a tax advantaged way and also create value for their own business. So the sponsor of MPXLP is Marathon Petroleum. See right here, MPXLP operates as a subsidiary of Marathon Petroleum Corporation. So, in other words, Marathon Petroleum Corporation, ticker MPC, Marathon Petroleum Corporation is an integrated downstream energy company. So what does that mean? It means they do refining. You have upstream, midstream, and downstream. Upstream meaning extraction, midstream meaning transportation, downstream meaning refining and sales or marketing. In the business of midstream, well, they are through their units that they have in the MPLX master limited partnership. So in other words, you have this refinery company that at one point in time had all these like pipeline assets. Those are midstream, either pipeline or like transportation through trucks and stuff like that. And those have really predictable, usually like fee based revenue streams that are very stable. Whereas oil refining and marketing is not stable. There's commodity risk with the fluctuating with the price of oil, gas, and all that. So there's an enormous amount of capital investment tied up in the pipelines. So by placing the assets, they have contracts, right? They have actual cash flows. By placing those assets into an LP, then or an MLP, then they're able to accrete cash flow to themselves and write off the taxes. Now they're already doing that, but it does create liquidity. Like they can sell their units. Like before, they owned 100% of all these assets. Now they own like 40 to 60% or something. And then there's investors like me who own other units, right? So uh, hopefully that made sense. Maybe some of it went over your head. But basically, the idea is because the entity itself, MPLX, is not paying the income taxes, you as the investor are, but you have certain tax advantages with your interest because let's say you receive 1,000 in distributions. They're not dividends, they're distributions. You receive $1,000 of distributions in a given year, but your taxable income on that might only be $800 because of depreciation of the assets in the entity or the pipeline assets or something. So in other words, private real estate, like the syndication model, it has these same economics. If you were to put your money into a real estate deal uh, with a GP, you would be an LP, you would receive a K1, and you would receive X amount of cash flow, but your taxable income on that it should be lower than that, or it might even be negative, depending on the value of the real estate asset. So that's the idea. Basically, what we're talking about, what this company does, is it is a midstream energy infrastructure and logistics company. Okay. So very simple to understand. The company's involved in the gathering, processing, and transportation of natural gas. the gathering, transportation, fractionation, storage, and marketing of natural gas liquids or NGLs, gathering, storage, transportation, and distribution of crude oil and refined products, as well as other hydrocarbon-based products and renewables. So we're talking about an energy company, but specifically midstream. And the thing about midstream oil and gas that I think is very important to understand is usually midstream is the most stable. It's the most stable business in the value chain, because if you're upstream, you're extracting the materials, or you're exploring then extracting. So you see how that's more risky, right? But then you have to transport the materials, and then you have to sell the materials. So um, the upstream provider is introducing supply into the market. The downstream provider is selling supply to the buyer with demand, whereas the midstream is just acting as the transportation of such. So anytime we're talking about an oil pipeline or anything like that, we are referring to a midstream, a piece of midstream energy infrastructure. If you've been following me for a while, you know that I love infrastructure as an investment due to its stable, hard asset qualities. Therefore, I really do like uh, MLPs. And this particular one has been a strong performer. One thing that I would like to do, we'll come back to that. So I want to talk a little bit more about the company, but before I do that, as always, I'm going to give my overview of the company. We're going to analyze the financials. Um, Financial analysis for an MLP is a little different than for a stock. It's not that different, but it's a little different. Um, I already tried my best to describe some of the differences between an MLP and a stock. I'm sure that I will continue to discuss that throughout. But we're going to, analyze the partnership. We're going to take a look at the valuation, and then we're, going to discuss some of the risks, and, do a basic technical analysis as always, and we're going to assign it a grade. So let's do that. So let's talk about MPLX. Let's just take a look at their website. They have a really, really simple and easy to understand website, which is good. So, per their own description, MPLX is a diversified large cap master limited partnership that owns and operates midstream energy infrastructures and logistics assets, provides fuel distribution services. So, formed in 2012 by Marathon Petroleum Corporation, MPLX is engaged in the gathering, processing, and transportation of natural gas. So, here's the meat and bones of it. The assets that it holds, and again, companies like this hold assets. That's their whole purpose. So, they own crude oil and refined product pipelines, marine business, crude and light product marine terminals, docks, light product and asphalt terminals, rail facilities, liquefied petroleum gas storage caverns, refinery tanks, loading racks and associated piping, crude oil and natural gas gathering systems, and NGL processing. So, what's the deal with all of that? This is basically um, it is exactly what it sounds like. It's infrastructure. It's real estate that has hard assets on top of it, or it's hard assets located on leased real estate. It's um, a bunch of expensive, capital intensive equipment that is moving these high value products. MPLX is the primary midstream provider for Marathon Petroleum Corporation, which is the largest refiner in the United States in terms of refining capacity. MPC has crude oil refineries in the Gulf Coast, mid-continent, and West Coast regions of the country. MPLX also has long-term relationships with a diverse set of producer customers in many crude oil and natural gas resource plays, including the Permian Basin, Marcellus Shale, Utica Shale, Stack Shale, and Bakken Shale, among others. If you're refining oil and gas products, you need crude oil and gas products. So long-term relationships with the diverse set of producer customers being upstream companies, right? So they serve upstream companies who need to sell their product to the refiner, and then the refiner sells their product to the end customer, like the Chevrons and the Exxon and whatnot, right? Those are the end customers, right, of downstream. For the oil and gas experts out there, feel free to chime in the comments and qualify and add to my statements, because again, I'm a generalist when it comes to evaluating businesses, and I'm sure that my explanation has leaves a lot to be desired. So what else can we gather? So here's a visual here of the assets. So we have, in the dark blue, we have light product terminal, either owned or part owned. Dark blue, excuse me. Light blue is asphalt / heavy oil terminal. The diamond being cavern. I'm really not sure what that means, if I'm being honest. This here being a gathering system, I believe what that refers to is the producing basin. Like I know here, this is the Permian Basin here. So that's the source of where things are coming from. You have your processing complex. Okay. I mean, just look at where all this is, right? The blue line, obviously, being a pipeline asset. These marine inland routes, obviously, that's the Mississippi River there. And you've got your marine facilities there. So, for example, you've got ships that are transporting all the way up through here from Minneapolis, St. Paul area down. As an example, we've got 1, 2, 3, 4, 5 marine terminals at the ocean. And we've even got pipeline assets here. So I mean, you can imagine with all of this infrastructure, this is what is keeping America afloat in terms of energy security, right? So the core thesis of my entire portfolio is consistent, growing, sticky, asset-based cash flows primarily. And this entity fits that very handedly. So, does the business have a moat? Right? We always discuss moat. Well, yes and no, right? Obviously, when you own these assets, right, there's an enormous amount of capital required to create the pipelines and the terminals and the processing complexes. And we see here the refineries are, MPC, right? So we see how there's an enormous amount of capital tied up in these operations, right? So there's a barrier to entry there. Not just anyone can go just create oil pipeline. You have to outlay billions of dollars to generate and create these assets. So there's a barrier to entry there. Not just anyone can go build one. Not just anyone can go buy one. There's a lot of capital required. Think about it like really high value, expensive real estate that has an operating component. So is it hard to replicate? Is it super sophisticated technology? No, not necessarily. But it is. It's the location element that makes real estate valuable, and it's the same thing with these assets. So there is a moaty aspect around the pipelines, right? That's very simple to understand. But the midstream business as a whole, not necessarily, because I'm really going to struggle to explain the way I'm thinking about this. And this is usually the part where I rely on the Morningstar report, which we'll take a look at. Economic moat. So we're referencing Brett Castelli. This was written on the 5th of February, 2025. So thank you, Brett, for your analysis here, and to Morningstar as a whole. We love your work and appreciate it. So Brett says here, we believe MPLX has a narrow economic moat based on an efficient scale moat source. The moat for these assets is based on their location. So that's exactly what I'm saying, right? Either directly part of a Marathon refinery or close by. And usually the asset is the only one of its type serving the refinery and handles all of its needs, making it uneconomic for competitors to enter the space. Long-term 5 to 10-year contracts containing minimum volume commitments for each Marathon asset provide an added layer of security that excess rents will last at least a decade, though we don't think they're needed to fend off competition. Fee rates for the contracts, yada, yada, yada. So I'm not going to read all of that, but basically what he's saying is, yeah, the pipelines themselves are moaty. I think that's what I mentioned. That's very simple to understand. The part that I was leaning on to help here, um, from an asset quality perspective, we consider the partnership's assets to have a narrow moat, as the logistics assets of the partnership directly serve Marathon Petroleum refineries. We consider them to be moaty. However, the incremental value gained in overall credibility with the market exceeds any modest benefits obtained by petroleum. This is way more complicated than what I was looking to do. And now he's talking about ESG. So, talking about how midstream firms have lower risk. Well, okay. So, Morningstar assigns it a narrow moat. I mean, I'm going to go a step further and say that this business, it's not too complex to understand, but there's a lot about this industry that I'm not super knowledgeable on, and therefore I hesitate to say with certainty like this has a strong moat, because there's a couple of these companies, right? And they're all the same. The only difference between them is they have different assets, right? So like this Morningstar signed Prologis, for example, a no moat company, and they develop real estate. The moat that you get from hard assets is based on their location. So I think it is fair to say that they have moaty characteristics, but this isn't some branded consumer product that um, engenders strong brand loyalty like companies we've covered in the past, Hershey, Philip Morris, etc. So let's take a look at the numbers now. How is this company doing? Oil and gas is a controversial industry. It's one of my favorite industries because I think there is a strong moral obligation for our us as members of society to um, perpetuate our energy independence that keeps us secure, safe, and prosperous. So um, there are certain areas of the market that I refuse to invest in. However, um, oil and gas is not one of them. I'd use the Seeking Alpha numbers. However, when it comes to MLPs, they don't always have super consistent reporting. Like for example, MLPs don't have earnings per share in the traditional sense. They have um, first off, they're not shares; they're units, and um, it's very important that we understand the difference between earnings and distributable cash flow. Again, earnings would be more realistic or applicable to a corporation that pays income taxes. Therefore, it has earnings after tax, right? Whereas a company like this is different. So we're going to take a look at these numbers here. These go back over the last 3 years here. And these are very easy to find on their website. You go to investors overview, this right here, investor relations packet. Okay. Anyways, so let's look at top line. Total revenue, 11.6 billion in 2022, 11.2 billion in 2023, 11.9 billion in 2024. Very, very modest growth, up and down, you see. The individual line items, we see you have service revenue, rental income, product sales, lease revenue, income from equity method investments. Um, there's a lot to unpack there. But I think primarily what we're looking at here when it says related parties, we're referring to Marathon Petroleum Corporation. But the majority, I would wager, of related parties, anything is attributable to intercompany or Marathon Petroleum. So very modest top line growth. One thing to note here is costs. You have depreciation and amortization. Let's take a look at the balance sheet before I go on. Cash and cash equivalents, 238 million in 2022, 1 billion in 2023, and 1.5 billion in December 31st, 2024. You see here how big the capital investment here. They have 19 billion in property, plant, and equipment. That item, you see that remains relatively flat. And then you see here, in terms of the amount of equity, we have our public unit holders and then Marathon Petroleum Corporation as a unit holder, right? So just like we're getting paid a big cash flow by holding these units, the current yield is like 7.25%. So is Marathon Petroleum, right? Makes it worth it to them. This is really the meat and bones of what we need to look at. Common unit distributions. Okay. So distribution coverage is effectively like our payout ratio when it comes to an MLP. In other words, for every dollar they pay out in distributions, they have $1.50 of cash flow, is what that means, right? So obviously, the higher that number is, the safer it is. Now, another thing is these companies are required to pay out a certain amount. MLPs are required to pay out a certain amount of their cash flow to the unit holders. And it just has to be that way for the structure to be a good deal for the government, essentially, for allowing it. So anyways, here we have the distributable cash flow attributable to LP unit holders. So what's important about this is, unlike a common stock, a company like this, an MLP, might actually issue more units in order to acquire more assets. In fact, they will regularly do that. Sometimes they'll, buy back the units or whatever. But very common, just like a real estate investment trust, to see a company like this issue units. So that's why this number here is the gross amount. This unit here is the distributions per unit amount. Obviously, for every unit you get paid, this is what, or every unit you own, this is what you make in income. If this is going up a lot and this is not going up that much, that means that they're issuing a bunch of units. And that's kind of like volume numbers. See, they're very transparent about a lot of things. I'm not going to go too much into this reconciliation of cash flow. So again, very easy to find this data. I would urge you to review it. You don't have to understand everything you're looking at, but if you're going to make an investment in a company like this, I would urge you to review this before you do so. This is another important thing to understand, I think, is that you want to see, do they have free cash flow after their distributions? Of course, their free cash flow is after distributions because their distributions is part of their financing cost, just like debt would be, right? So yeah, ideally you want there to be some money left over after distributions because that will accrete cash onto their balance sheet, which they can use for growth capital expenditures. Growth capital expenditures. And basically what that does is it um, accretes property, plant, and equipment to their balance sheet. You see here that number is in excess of just the free cash flow, which is fine because, again, these are CapEx numbers, which would actually should get netted out here. Anyways, I'm getting way too into the weeds with this. At a high level, what we should be looking at when it comes to these types of companies is that they're going to trade at yields that are probably between 6 and 12%. And they shouldn't be very high growth. I think if you're looking to make to deploy capital into a MLP, um, your yield plus a very modest level of growth, like at least 2%, 2 to 3% per year. Um, the chowder score is important, but with the chowder score, you're going to have a much bigger yield than growth level. So I really like these investments because they create consistent cash flows. Okay, they create consistent high yield cash flows. Um, um, However, you have to keep in mind that that you see, the yield that you see is pre-tax, whereas a dividend yield on a stock is post-tax, right? Now, obviously, you get taxed on your dividends, but you get the idea. MLPs should always trade at higher yields than a corporation with the exact same characteristics. I will take a look at these numbers just to give you the equivalent analysis. So revenues, you see how much revenue has grown, but you have to understand that this is a subsidiary of another company, and that company could just be dumping or selling assets into it, if that makes sense. Like, in other words, Marathon Petroleum owns, we saw that on the map. Marathon Petroleum owns all these, at one point in time before they started MPLX, they owned all these assets, right? And they effectively sold them into the entity. And there's liquidity there, right? There's liquidity there that rolls back up into MPC or Marathon Petroleum because investors like me are buying units, and then that cash is buying these assets. So when we see revenue growth from a billion in 2015 to 11 billion, it's not that simple. Okay, you're not going to see an 11x gain in the unit price because the amount of units that they have has surely gone way up. In fact, yeah, we see here the they say shares, we know it's units. There were 300 million units in at that time, and now there's a billion units, right? So that gives you an idea of revenue's gone up by 11 times. The unit count has gone up by 3 1/3. So that should have accreted uh, unit holder value. That should have accreted unit holder value, assuming steady margins. But don't look at these numbers and feel like you're seeing some crazy deal. Okay, you really got to understand what you're looking at when it comes to an MLP. Same thing with operating income. Um, I would not give too much weight to kind of these standard gap measures of financials. Instead, you want to make sure that your distributable cash flows are increasing. And we see here from 2022, 4.8 billion to 5.5 and a quarter billion to 5.7 billion. So that's almost 10%. That's like 7 to 9% per year. That's really good, right? That's really good because remember your yield right now 7%. If the distributable cash flow is growing by 7 to 9% and you're getting a 7% yield, assuming that they don't issue more units, that's a very, very strong 15-16% return, right? Potential, assuming that the unit price follows the fundamentals. So I would strongly urge you to take a look at these numbers yourself. But distributable cash flow numbers looking good. The coverage ratio looking good. It has trended down slightly. Well, the reason for that is because they've actually raised the distribution by 12.5% 2 years in a row each year, which is more than the DCF, which is questionable. I think obviously that's good for me as the unit holder. I'm getting a double digit distribution raise. However, I would like to see the distribution raise be at or below the level of organic growth. But nonetheless, I digress. So let's talk about the valuation. Let's talk about the valuation. I'm gonna need to do some manual numbers here, but in 2024 we had 5.7 billion, right, of distributable cash flow. Our current market cap is 53 billion. So that's less than a 10 times multiple. You see here how it says we're at 11 and a half. That's because earnings are different than distributable cash flows. Hopefully that illustrates the point I'm trying to make. I am more than happy to pay less than a 10x multiple on these cash flows that I believe are very, very safe, fairly safe and fairly stable. Seeking Alpha agrees that the valuation is good. Again, it's harder to use Seeking Alpha to analyze master limited partnerships. You need to do a little bit more diligence. But we see here price cash flow is good. Price over book is important because of how much asset value there is in something like this. Seeking Alpha is saying compared to the energy sector, price per book is high. Okay. A 4 times book value. Yeah, it is a lot. In other words, if there's no cash flows, you're not getting your money back if they have to sell off these assets. Part of that might be, though, that the book value has been depreciated away a lot. So it's hard to, look at these numbers and really know what's going on there without doing some sophisticated financial analysis. So I'm going to keep it real simple. Again, look at this free cash flow yield, 8-9%, very good. The dividend yield is it's actually come down a lot. I think when I originally bought this, it was in the fourth quarter of 2023. It hasn't, reliably compounded yield over time. It's slow and inconsistent, but it's you see here what happened in the COVID crash. This thing was trading at a 30% yield. It's wild, right? On a yield basis and a multiple basis, it has appreciated a lot the last couple years. You see it's up 30% year over year, up 240% in 5 years, which is almost the bottom to the day. It's really good. So it's performed phenomenally well. I still think the valuation is attractive. The last thing I wanted to cover in terms of this was um, our dividend growth. We see here, yeah, this thing has steadily compounded. In fact, they haven't done this the last few years, but at one point in time, they were raising just about every single quarter. And you see very, very strong raises. They raised by 7 cents here. Sorry, that the 12.5% raise was here. This was, almost 10%, 9 8 or 9% raise here. Very strong dividend growth. Very strong dividend growth. And they've raised the dividend every year over time. And they even paid out a special dividend in 2021. So very, very strong cash yields. I like the valuation a lot, obviously. There's not many places in public markets where you can get such juicy yields below, a 10 times multiple on the business. But there's a reason that it trades a lot cheaper than other things. The reason being that it is an entity that has a very specific purpose and it's not going to grow super fast over time. However, this business has grown pretty good the last few years. I would maybe not expect that over the next few years. However, I would be perfectly content with no price appreciation and collecting a 7.25% yield. So the valuation is good. Let's do a technical analysis. We see here it has very reliably traded with clear uptrend. In fact, really over the last several quarters, it's really hit a new gear here. And we see here I've got two moving averages, the 6 and the 18. Each of these candles is a week, so 6 week and 18. I mean, even you see here, there's just the tightness of the trading range. I'm not going to calculate or show you the beta and the volatility on this, but I know from a fact, looking at the chart, it is very low. However, you do see historically lots of volatility, and this isn't a very good looking chart long term. So just understand that. But these MLPs have been in a bull market since COVID. Given that this company is closely tied in with refining capacity, oil and gas, I see a very favorable operating environment for it. And that's been made even more severe by the trade war stuff that's been going on the last few weeks. The uncertainty of the Trump regime right now, I don't want to say it's a tailwind for this company, but think about all the things in the news about, Canada's going to cut off energy. Again, that's to these states along the seaboard here. Canada's going to stop energy and all this. I mean, doesn't that benefit a company like this? So I see a lot of reasons to be bullish. I think just from a technical perspective, it's just had a very, very strong run. I mean, even in 2022, you had a bear market in the broader market. I mean, there was barely a hiccup here, basically traded flat, kept going up. So this stock, or excuse me, MLP, has kind of been up only really since COVID. I see a favorable operating environment. I believe that that will continue. I've continued to add small lots here and there along the way the last several years. So, yeah, I think there's no real discernible chart pattern here, but it's easy to see that it's in an uptrend. And when it sells off a little bit, like we'll zoom in, when it sells off a little bit, it very quickly recovers. And volume is very consistent. In fact, there's hardly been a big volume spike since here. But one thing to keep in mind in a bear market where energy prices are coming down a lot, you're probably not going to have much margin of safety here either. We see, all stocks sold off pretty bad in COVID, but this one did exceptionally poor. $23 all the way traded to 7, right? So it went down by 70% in January 20th. When in 2 months it went down by 70%. So just it's been very safe as of late. You have very little volatility either way, but just know that it is correlated to energy prices, of course. Even though the underlying business doesn't have quite the commodity exposure that the refinery and the upstream companies do, it's still the price of this is exposed. So what do I think that it's a buy? I absolutely do. I just think it's a good deal, despite the fact that it's done well. It's just a sound, solid valuation. I like the underlying assets. I like the industry. I like the exposure. It's not for everybody. It does increase your filing costs for taxes. I gotta have a CPA firm perform my tax return for me, and I hand them several of these forms, among other things. If you just do TurboTax or whatever with your returns. I'm sure you can easily upload this. It won't really increase it that much, but just know that every time you get paid a distribution or dividend from this, it lowers your taxable basis, and eventually your basis will be lowered to zero, at which point every time you get paid, it is a capital gain subject to long-term capital gains taxes, assuming that it's not distributing 100% per year. So just something to keep in mind. I haven't made a video on it yet, but this is the first time. I think it's been a solid investment for me, and I have no plans on selling. If anything, I would look to add more on a sharp pullback, just because I think that the operating environment is very favorable. I think that the immediate term environment is very favorable. I think that it's very profitable at low oil prices, which we're at now. We're at lower mid 60s oil prices, and feel very good about the future with it. But I'm an income oriented investor, and it appeals to me. If you're not an income oriented investor and you're looking for growth, maybe look elsewhere. However, I do assign it a grade of buy. Again, not my recommendation, just my opinion. Don't go out and just rush to buy this because I said it was a good investment for me. Really understand the implications around tax and whatnot with it. But, anyways, I'm running out of time. So I'm going to jump, but it's been fun. Hopefully you found this educational and interesting. Please comment, leave me some feedback, ask me about things you want to see. I've been really bad about getting to some of the viewer provided suggestions, primarily because I have so much to cover, but also because I've been getting pulled in a million directions with other work. However, I've let go of some other projects I was working on, and will be spending more time on my content in the go forward. So, anyways, I will quit talking your ear off. It's been fun. Thank you for watching. I appreciate you all, and I will see you next time. Bye.